Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open. A deceptive calm masks a violent capital rotation. While major indices appear steady, a hardware supercycle is erupting as software giants stumble watch for the opening bell to confirm this historic capital flight. Second, Wall Street's high-stakes gamble. Defaulted Venezuelan bonds skyrocket over 100%, but a hidden $10 billion of Chinese debt threatens to derail the entire rally. The rally price is in a perfect outcome, but China looms as a shadow creditor. Will Western fund giants get trapped at the open, or is this a geopolitical payout about to ignite? Finally, Fed versus Tech CEO. A power play unfolds as a top official, and AMD's Lisa Su clash on AI's job market impact, creating a critical policy dilemma. This public battle could trigger a major Fed policy error. How will the market price this conflict at the open as a signal for a soft landing or an inflation crisis that could rock tech stocks? Just when the broad market indices seem to be lulling investors into complacency, a massive structural rotation has begun under the surface that changes the entire playbook for 2026. The headline numbers are deceiving. While the S&P 500 finished essentially flat, closing at 6,949 points, and the Nasdaq Composite managed a modest 0.65% gain, the internal dynamics tell a story of violent capital repricing. We are witnessing a decisive shift from the software-dominated narrative of last year into a hardware and infrastructure supercycle. The bulls are still here, but they are rapidly changing addresses. The divergence is stark. The Dow Jones Industrial Average climbed over 1% to 49,478, driven by industrials and energy sectors that were left for dead during the Magnificent Seven era. This is not a rising tide lifting all boats. It is a calculated migration of capital. The market is effectively telling us that the valuation saturation in mega-cap technology has reached a tipping point. Nvidia, despite stellar news flow, closed flat. Meanwhile, under-owned storage and infrastructure names are erupting. This is the classic signal of a market moving from the promise phase of AI to the plumbing phase. The catalyst for this rotation is twofold: a confusing Federal Reserve and an explosion in physical infrastructure spending. First, let's address the macro elephant in the room. Minneapolis Fed President Neil Kashkari has effectively shattered the consensus view that rate cuts are automatic in 2026. By stating the central bank is pretty close to neutral, he is signaling that the easing cycle might be over far sooner than the bond market's pricing of 2 cuts suggests. The 10-year Treasury yield sits stubbornly at 4.17%, a level that historically compresses valuation multiples for high-flying tech stocks. If yields breach 4.6%, analysts warn we could see rapid downside re-rating in the most expensive growth names. However, offsetting this rate anxiety is a capital expenditure tsunami that is impossible to ignore. Wall Street consensus for 2026 AI capex has been revised upward to $527 billion. This capital is not going into the ether. It is flowing directly into the physical backbone of the internet. We are seeing companies like Meta Platforms raising their capex guidance to over $70 billion, specifically for data centers. This spending floor is providing a safety net for the hardware sector, decoupling it from the broader consumer economy. The most explosive evidence of this shift is in the storage and memory sector. SanDisk shares skyrocketed nearly 28% in a single session, with Western Digital following with a 17% gain. This was not a meme stock rally. It was triggered by NVIDIA CEO Jensen Huang's keynote at CES, where he identified memory storage as a completely unserved market. The technical reality is that AI models require massive amounts of flash storage for KV cache functionality, a bottleneck that current data centers cannot handle. Analysts point out that if Chinese demand for the H200 chip materializes, as reported, it implies a storage deficit of over 30 petabytes. The market immediately recognized that storage suppliers now possess pricing power that rivals the GPU makers themselves. Contrast this with the price action in NVIDIA and Broadcom. NVIDIA shares drifted lower by nearly 0.5% despite the bullish CES presentation. When a stock fails to rally on excellent news, it is a hallmark sign of valuation exhaustion. The market has already priced in perfection for the chip designers. The smart money is moving down the value chain to the equipment suppliers, companies like Lam Research and ASML, and the memory makers who are just beginning to reprice their growth assumptions. On the losing side of this rotation is the consumer discretionary sector, headlined by Tesla's 4% pre-market slide. The EV giant reported an 8.5% year-over-year decline in vehicle sales, its steepest drop ever. This is a collision between valuation and reality. Tesla is priced for hypergrowth and autonomous dominance, yet the data shows market share erosion in Europe to competitors like BYD. It serves as a stark warning for the broader discretionary sector. Premium valuations require flawless execution. With consumer spending softening and competition heating up, names lacking a competitive moat face significant downside risk. We are also watching a tactical geopolitical play unfold in energy. The US intervention regarding Venezuelan oil reserves sent crude prices up nearly 2% and triggered a 7% rally in energy services stocks. While the Energy Information Administration predicts oil prices will moderate later in 2026, the immediate reaction highlights the market's sensitivity to supply shocks. Chevron, the primary US operator with assets on the ground there, is seeing capital inflows as investors position for a potential production ramp-up. Looking ahead, the market is approaching a critical test at the January 27th FOMC meeting. The divergence between the Fed's hold rhetoric and the market's cut expectations must be resolved. Until then, the trend is clear. Capital is fleeing valuation risk in software and EVs and finding a home in the tangible infrastructure of the AI build-out, memory, equipment, and power. The easy money in the megacaps has been made. The next phase belongs to the builders. The most unexpected news in the finance world today has to be one of Wall Street's hottest trades, a defaulted bond from a failed state. Prices on Venezuelan government bonds have more than doubled since August, soaring to 43 cents on the dollar in a stunning reversal for an asset once left for dead. Now, get this. A bond trading at 43 cents implies the market is betting on a very optimistic recovery. The direct implication, according to research from Citigroup, is that for Venezuela to achieve any kind of debt sustainability, creditors would likely need to accept a haircut or a reduction in the principal owed of at least 50%. Even with a complex restructuring, analysts estimate the net present value of these bonds lands somewhere in the mid-40s. So, today's price is already baking in a near-perfect outcome, creating a high-risk trade that could reverse sharply if reality falls short. We previously analysed how the political bombshell in Caracas wouldn't instantly translate into barrels because Venezuela's oil output is a classic lagging indicator. What really brought this to a head was the market leaping from that political shock to a financial conclusion. This explosive rally is being fueled by the surprise removal of President Nicolas Maduro and a dramatic shift in US policy that has traders betting on a swift debt restructuring. The new US policy to directly engage with Venezuela's oil sector creates what some are calling a novel geopolitical backstop for creditors. A while back, we noted Washington signaling total access to Venezuela's reserves and the way refiners ripped on that read-through. Today, the focus shifts to how that same policy signal is being interpreted as a creditor backstop. Oil production forecasts are no longer just an economic indicator. They are now a direct leading indicator of US foreign policy execution. This tests whether direct foreign intervention can fast-track an economic turnaround in a way traditional programs cannot. Major asset managers like Fidelity and T. Rowe Price are reported to be significant holders of these defaulted bonds, placing them at the center of this gamble. But the optimism is clashing with immense risk. The core conflict is whether a new government can stabilize a nation in ruins. According to Barclays, Venezuela's total claims, including past due interest, have ballooned to a jaw-dropping $98 billion. That figure represents roughly 119% of the nation's entire projected 2025 economic output. A while back, we also noted that China had been Venezuela's economic lifeline through oil for loans that once totaled over $50 billion, tying Caracas's barrels directly to Beijing's energy security. That history matters here. However, if you zoom out, you'll see another layer of strategy at play. That $98 billion figure doesn't even tell the whole story, because the market seems to be ignoring a massive missing creditor. China. Venezuela owes China approximately $10 billion through opaque oil for loan deals. Without China's participation in these restructuring talks, any US-led deal is fundamentally incomplete and risks being undermined. This could leave Western bondholders facing years of further delays or finding their claims subordinated to Beijing's. Continuing our last discussion, experts warned it could take a decade and more than $100 billion of investment to restore Venezuela's oil capacity, and OPEC Plus holding output steady was effectively a bet that those barrels won't return quickly. Adding to the tension, the country's economy is now 30% smaller than it was 8 years ago, with oil production nearly cut in half, and rebuilding that oil capacity won't be easy. Even with a US backstop, the infrastructure is so depleted that analysts at Wood Mackenzie project that production could actually fall further before any significant investment can begin to turn things around. That, combined with the fact that we previously challenged the massive oversupply narrative, remember US crude inventories running below the 5-year average, means the oil price path that would fund bond coupons is uncertain, not guaranteed. This could create a cash crunch for the new government right when it needs stability the most. One analyst from Citi is calling the situation a big gamble, questioning the new leadership's alignment with Washington. And Jeffrey Sherman, Deputy CIO at Double Line, warns it is way too early to get too excited, suggesting the rally may be running far ahead of reality. Ultimately, this situation in Venezuela could be rewriting the rules for emerging market investing by introducing a new risk factor beyond pure economics, geopolitical alignment with the US. Heading into the open, watch for potential contagion effects. We could see a performance divergence between the bonds of US adversaries like Cuba and other defaulted nations that are on better terms with Washington like Sri Lanka or Zambia. Watch for any signs of how the market is pricing this extraordinary risk, as a massive bet on political change goes head-to-head with the grim financial reality of a nation on the brink. And as we've said before, the quiet tells matter. OPEC plus cohesion, China's refinery runs, and those weekly US inventory reports will show whether the policy backstop is turning into real cash flows. Speaking of high-stakes gambles with massive economic implications, a major debate is erupting between a top Federal Reserve official and one of tech's most powerful CEOs over the future of the American workforce. We previously analysed how the Fed is trying to navigate an economy being reshaped by AI investment, and the latest development is this very public split between the macro view and the operator's view. Advanced Micro Devices CEO Lisa Su just went on the record stating her company is not slowing down hiring because of artificial intelligence. In fact, she says AMD is hiring significantly, but with a new priority. Her exact words, "We're hiring people who are AI forward." Interestingly enough, this isn't just a corporate strategy, it's a reflection of a global sovereign AI race. Nations from Europe to Japan and Saudi Arabia are pouring billions into building their own domestic AI ecosystems. This has ignited a fierce global talent war for people with these exact skills, which could drive up wages for this select group and determine which nations lead the next technological wave. A few episodes ago, we flagged that this scramble, especially for chips and energy, can create its own inflationary pressures, even as AI promises longer-run productivity gains. Sue claims that for her company, AI is not replacing people, but augmenting their capabilities and productivity. The ultimate test of Lisa Su's claim will be whether this massive investment in AI actually shows up in the economic data. Economists have a specific measure for this called multi-factor productivity, or MFP, which tracks how efficiently we use all our resources, including labor and capital. If Sue is right, we should eventually see a boom in MFP. If we don't, it could suggest the current AI investment cycle is more hype than real economic substance. Continuing our last discussion of the productivity paradox, Chair Powell's "we're going to have to see" caution still applies. These gains often take time to show up cleanly in the data. But that statement stands in stark contrast to a recent warning from Minneapolis Fed President Neil Kashkari, who said AI is causing big companies to slow hiring. This creates a direct conflict between a central banker's economic outlook and the view from inside the AI revolution itself. The situation presents a fascinating duality. On one side, you have the high-demand AI-forward jobs Lisa Su is hiring for. On the other, you have non-AI sectors where companies are becoming more cautious, which is what Neil Kashkari is observing from his macroeconomic viewpoint. This could create new forms of wage inequality and complicate the Fed's goal of a soft landing. As we discussed a while back, in periods of intense churn and skill mismatches, leading indicators and lagging indicators can tell different stories, so the jobs data may look healthy or weak for reasons more about churn than trend. Here's where it gets interesting. If the Fed misreads this structural shift in the labour market as just a simple cyclical slowdown, it could lead to a major policy error. If the Fed eases monetary policy and cuts interest rates prematurely, thinking the entire job market is weakening, they could risk reigniting wage inflation in those skill-constrained AI sectors. And as we noted a while back, if AI-driven productivity ultimately lifts the neutral rate, R-star yields can stay under upward pressure, making premature easing even riskier. The stakes for AMD are massive. The company is fighting for ground in a market completely dominated by its rival, NVIDIA, which holds an estimated 90% share of the AI chip space. To be even more precise, recent industry analysis shows NVIDIA's dominance is staggering, with some reports indicating they shipped 98% of all data center GPUs last year. This isn't just a competition, it's an arms race. Su's strategy to build an AI-forward workforce of over 28,000 employees is a direct bet on a different path forward. This intense rivalry between just two companies also creates a critical choke point in the global tech supply chain, making it vulnerable to geopolitical tensions and US-China trade policies. And remember, as we highlighted a while back, an investment tsunami can boost demand faster than supply, fueling pocket inflation and stretching valuations. The classic setup for an AI bubble risk if profits don't keep up. This high-stakes split between a top tech executive and a Fed policymaker puts the entire AI narrative in the spotlight. At the open, look for how investors weigh these two conflicting views. Watch the technology sector, including shares of AMD and NVIDIA, as trading begins to see how investors price in this fundamental disagreement over whether AI is a force for job creation or destruction. Also, keep an eye on broader semiconductor ETFs, like the VanEck Semiconductor ETF, which trades under the ticker SMH, for a sense of how the entire chip sector is reacting to this debate, and on productivity prints and longer dated yields for early signals of whether the AI story is feeding inflation, lifting MFP, or both.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.